Welcome back to another episode of Investing Explained. Here's today's question.
That's a pretty difficult question because it really depends on which industry you're talking about. It could depend on a lot of other factors, but what you're really talking about is private equity here. You know, some of it is just pure competition. When you have less participants bidding up the price of something, that can create value. When you're talking about risks associated with investing in a company that maybe doesn't have these characteristics that you're talking about of a standard value-based investment, some of it is just institutional knowledge, like a Reid Hoffman seeing a business and being able to invest in a business. And I'm not calling everybody that's in that space a Reid Hoffman, but people who have invested in that space for a long period of time kind of know what to look for because they've done it one or two times previously. And some of it might just be, because I don't know the statistics on this, some of it might just be perception that there's better returns in these spaces without actually knowing that they in fact are. From the friends that I have in private equity, they tell me that the discount rates that they are using are definitely higher than what you're seeing in the public markets.
It's a very timely question now that we're doing this episode about Reid Hoffman. You know, think back on the question about PayPal. Like, how would you value PayPal whenever they pivot 3 or 4 times during 9 months? How are you going to value that? You probably don't want to do that. It's definitely not by conventional metrics. One other thing that Preston was talking about there is typically referred to as survivorship bias. You might think back on companies like, Facebook, company like Square right now, which is very relevant. They've been making tremendous returns to their investors. There's been so many companies who have tried to make payments easier and failed. We look at Square now, and we look at those who invested in Square back then, and they have made so much money. But it's very, very difficult, and you do see the survivors and not all those fails. The underlying principle of what we're talking about here on the show is that you can foresee with somewhat reasonable accuracy what the future will bring. If you can't do that, you can't make this discounting of the expected future cash flows because, you don't know what to expect. So you can't really make an assessment of the value. If we take a company like Facebook as an example, if you look at their year-over-year growth in the early years, 1 year, 2,150% growth. The following year, 433% growth. And then 219% growth. So they're going from very little to 153 million in revenue in 2007. How are you going to value that? The other side of the coin is also that Preston was talking about discount rates of north of 7 or 8% or whatnot. Depending on where you are in the states of these companies, you have to use really, really high discount rates. If you're talking about companies that would either grow by 500% or fail because they're just burning cash, I wouldn't know what type of discount rate I would use at all. I would like to say a few things about venture capital here because yes, we're doing this episode about Reid Hoffman. We've done bunch of episodes before about Silicon Valley and venture capital, and for me, it's very glamorous and it's very exciting. I would also like to bash venture capital a little here and say, yes, it is important for society that you have risk-seeking capital. Yes, it's a very important role to fill out, and venture capitalists should have all the praise for that. Whenever you go to the bank and they say, you can't do that because you don't have a proven business model, that's whenever you have Silicon Valley and venture capital, because by definition, if you have blitzscaling companies, they do not have a proven business model. I think the issue that I have with some of these tycoons and everything that's around it is that they're looking at funding as the means to exit the company, typically in the shape of an IPO or a takeover for someone else. But why is it that all these VC companies want IPOs for their investments? You can argue good arguments that it's the fund structure and they have to pay back their investors, they have to diversify. There are many good reasons why they're selling. But keep in mind, whenever the public has access to whatever kind of security there is, it's Silicon Valley that's selling it. And they're very, very aggressive in the way that they say, this famous investor, Reid Hoffman, Peter Thiel, whoever, he invested in it. He has that, approval stamp on it. Or, this IPO company, they would take over the world. Like, you should buy into it. And you might be thinking, that sounds like a great business thesis. Also keep in mind, they're selling a product. They're basically saying, please take it off my hands. Like, here are all the good reasons why you should buy it, but I'm actually selling it. I'm not going to own it anymore.
I have to piggyback on this because it goes back to the book recommendation I had earlier in the show, which is this book called Bad Blood. And one of the things that was really fascinating with the demise of this company was the amount of venture capital that kept being thrown at this company. Real fast, so Theranos, the company, they were trying to take blood samples in wherever location, and then this device, this piece of hardware at whatever remote location. So if you were at a Safeway, you could go in and you could have a small blood sample taken, and they'd put it in this machine, and then this machine supposedly could conduct the lab result on station right there, and it'd be all done through the mechanical machine instead of sending it out to a lab for a couple days and then the results coming back. Well, the technology was a total farce. The machine was supposed to be able to do hundreds of different lab tests, but it actually couldn't. Going to Stig's point, they had VCs that kept throwing more and more money at it. And from what I could gather from the book, it seemed like the reason it kept getting more and more money is because people would say, oh, well, so-and-so, they made a really big investment in this company. So, this thing's going to change the world. And so then people would immediately have a bias to there being a research being conducted by that really talented venture capitalist or that other venture capitalist firm. And so that was outsourced. The knowledge and the understanding of this very complex and technically challenging business to understand was just outsourced, and the narrative was quickly derived that, oh, well, if so-and-so invested in it, the technology must be gold. And it wasn't. It was all a falsehood. But it just shows you how the snowballing of some of this VC money can be built in brands of other investors. Just some really interesting things to think about, especially if maybe you recently had a windfall and you're trying to step into the VC space. Be very careful of that. This book is so good, so I'm going to leave it there.
The other thing I'd just like to say is for public listed companies, which is really like where Preston and I, the things that we talk about, whenever we talk about security, is typically something that's public. Just keep that in mind, it's public. That's actually the important thing. It sounds very boring, and it probably is. It's not as exotic as Uber or Square or Airbnb. But, because it's public, it's also transparent. It's not this machine that, even if it was public, I don't think anyone can understand what it actually did. Everything is transparent, and it has to be transparent. And yes, that also means that your potential upside is probably not going to be as high if it's public, but your downside, don't lose money. It's a lot more limited too. I think that's something I want to put out there. And I don't know if we really answered your question, other than you probably won't. You probably won't be using the tools that we have and the formulas to access the value of security. I think that should also tell you something. If you can't value it, don't buy it. That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.